Jim Rickards, in your book, you say we are in the middle of a currency war right now. Where is that war being waged?
It's being waged all over the world, but the main front is between the U.S. and China. You know, there's been a lot of talk about China as a currency manipulator. There's no bigger manipulator of the currency than the United States. The way to understand quantitative easing, QE2, and Operation Twist, interest rates can't get much lower, but it is a way to cheapen the dollar. There's actually an academic pedigree, Lars Svensson, who was one of Bernanke's mentors at Princeton, wrote a paper on this. He said, when rates are zero, you can still generate inflation by cheapening your currency. That's what the Fed is doing.
Let's talk about China.
Sure.
Congress is yelling that they want a stronger yuan. Should they have it?
Well, first of all, it won't do any good. In the 1970s, everyone was upset about Germany and Japan. We wanted a weaker dollar and a stronger yen and a stronger mark. We got it. We trashed the dollar relative to those currencies. Guess what? 40 years later, Germany and Japan are still export powerhouses. It doesn't change anything. Take the iPhone, for example. We love our iPhones. They come from China. The Chinese value added in an iPhone is about 6%. So if you took the dollar down by half, it only changes the price by 3%. It doesn't do any good. So that's one of the problems. You get inflation, you get retaliation, you get bad results. What you don't get is economic growth. You can't cheapen and print your way to prosperity.
Well, you mentioned the yen. Right now, the yen is in the mid-70s. Japanese government can't weaken it despite trying multiple times. What's going to happen with the yen?
Well, the yen will probably, continue to get stronger because of the repatriation trade. As you know, they've got a lot of rebuilding to do after Fukushima. So their external investors and the corporations are basically selling dollars and euros, converting to yen, taking it back to Japan. Now, the government doesn't like it, and we had a G7 intervention led by Christine Lagarde in last March. After Fukushima, but the yen will continue to strengthen. It has for a long time.
Well, thanks for the segue. Let's talk euro now.
Sure.
What happens if the eurozone breaks up?
Well, I don't think the euro, it's a good question, Greg, but I don't think the eurozone will break up. I've been one of the voices saying that the euro is strong and getting stronger. Where people get confused, you have bonds, banks, and the currency. The bonds are trash. Some of them are 40, 50 cents on the dollar or less. The banks are a mess. Some of them are going to fail and be nationalized. That does not mean the currency is a mess. The currency is a separate thing. Lehman defaulted on billions of dollars of obligations. It wasn't the end of the dollar. It was just the end of Lehman. So again, you'll see these banks and countries fail, but not the euro itself. The euro should not really be understood as an economic project. It's a political project. It's a way for Germany to dominate Europe, which they've always wanted to do since Charlemagne, without firing a shot. And they're actually having some success at that. Also, China and the US both want a strong euro, because remember, we've got to trash our currency. The problem with currency wars is not everybody can devalue against everyone at once. There has to be a strong currency, and right now it's the euro.
Finally, let's bring it home to the United States. In the book, you advocate a flexible gold standard for our currency. Can you explain that?
Well, it's actually my second choice. You're right. My first choice is King Dollar. I'd like to see a strong dollar, but I don't see it. During Volcker, Reagan, we had hard money and low taxes. Today we have cheap money and high taxes, so it's exactly the wrong medicine. So I do see it playing out in gold space, but you can have a modern gold standard where actually the Fed would say, pick a price. I think $5,000 an ounce would be a good way to start, and conduct open market operations. There were a buyer at $49.95 and a seller at $5,050, and if a lot of gold shows up, the price is too high, and if the gold is coming out, the price is too low. Use market forces to determine what the price of gold should be.
So to sum up, if you're saying start at 5,000, is that what you mean? You think gold will trade up to 5,000?
I think gold will go probably to 7,000. I'm using 5,000 as an example. And it's not some pie in the sky projection. It's actually, every gold standard is just some relationship between paper money and gold. So it's really just 8th grade math. Now you have to say, well, what money supply? Do we want to use M0, M1, M2? It makes a difference. How much gold backing do we want? 20, 40, or 100%? And who's in? Is it just the US or is it everybody? So those are your inputs, but based on that, you get a range of $3,000 to $40,000 an ounce. I think $7,000 will do the trick. So when confidence in the dollar is lost, that'll be plan B.